Okay, so for today's session of First Things First, we're going to talk about diversification. Merton Miller was a Nobel laureate who coined the phrase, diversification is your buddy or the closest thing to a free lunch. And while there's lots of different levels of diversification, for time's sake, today we're just going to look at diversifying among the number of stocks in the portfolio. So over the years, one of the more common comments I've heard is, can we not just take a small handful of stocks rather than the diversified big portfolio of stocks? And I get where the question comes from, but let's look at a couple reasons why that's actually much more difficult than it sounds. So first, it's easy for us to look backwards and say, we should have had these ones in the portfolio. The old hindsight is 20/20 concept. But the question is, how do we look forward and in advance pick all the winners? And probably more importantly, what is the risk or cost of choosing the wrong ones? So let's look at a real life example here. We're going to look at the Russell 3000. The Russell 3000 is a US index that has about 3,000 of the largest US stocks in it, so very diversified. And if we look back over the last 40 years, this diversified portfolio has had an average annual return of approximately 11.6%. So the real question we're asking today is, what are the odds that we could select a handful of stocks out of that portfolio that would have a rate of return higher than this? Well, we have the data. So here's what the data actually tells us. 66% of the stocks from that basket actually underperform the portfolio as a whole. And we can further break that down into about 24% that were below the portfolio, but were still above 0%, but they were still positive, at least. But there was a staggering 42% that actually had a negative rate of return. 4 out of 10 stocks had a negative rate of return over this time period. So while you're letting that sink in, we'll jump to this side over here. And what we see is that about 34% actually outperformed the portfolio. And that can be further broken down into about 24% that had a return greater than this, and about 10% that were what we would call home run rates of return. So a lot of data here to look at and digest. But here's the takeaways that I want you to get from this. Just looking at this, we can see, first of all, that it's very, very difficult, or the odds are very low that we would be able to pick the winners in advance. Okay? And secondly, and this is probably more importantly, is that the cost of picking the wrong one can be quite high. So we'll sum it up like this. The diversified approach gives you the best probability of achieving all the rate of return that the market is willing to give. And who doesn't like a free lunch? That's it for today. Thanks for watching. We'll see you next time.